The bottom line is access to capital is king. Paying cash in today's environment, in most environments, quite frankly, is going to cost you more in the long run than actually financing if you handle the cash properly. Because I can show you that at 4%, if I could earn 4% on that money, I'm going to earn more on that 4% than I would actually pay in interest expense at 5%. And why is that? It's because over here, if I'm paying 5% on that loan, hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're going to be talking about opportunity cost. And I'm going to try to keep this one brief because it's not the most complicated thing to understand, but I think it is probably one of the most important components of personal finance to understand because, I'm a big believer. Just look at the math. There's a lot of people out there who talk about personal finance and they tell you that you should invest in a certain way simply because, the emotion and human behavior and stuff like that. Well, I'm also a big believer that if people really truly understood the real dynamics of personal finance and how money worked, that human behavior would change, right? And so, the idea here and where I'm going with that is, I guess I'll just call it like it is. So Dave Ramsey talks about the fact that cash is king all the time. You should never finance a depreciating asset. I'm just going to use this as an example because it's the most overt example I can think of. His idea is you should never invest in something that is a depreciating asset that you can't afford to pay cash for. So for example, he would say, don't go out and finance a car. If you can't afford to pay cash for that car, you shouldn't be buying that car. You shouldn't be driving that car. Now, here's what I'll say. I agree with Dave that you should in fact not be driving that car if you couldn't afford to pay cash for that car. Okay, so first and foremost, all you guys who are big Dave Ramsey fans, don't call me and scream at me because I agree with him philosophically on that. Where I lose him or where he loses me is kind of the next step where he says you should only pay cash for that car because it makes no sense. Why would you? So and I'm going to take a step back and say his idea, his reasoning for paying cash for that car, if you think about it, is because he's trying to get you to avoid the interest expense that you would be paying on a loan, right? So let's break it down and let's take a look at this and just say, okay, if I were to pay for a car and go out and do a 5-year financing deal on the car and let's say pay 5%, I think that overall I would be paying somewhere in like the $3,950 range, maybe like $4,000 range for interest expense. So my car payment overall, I'll take the $30,000, but I pick up the $4,000 of interest expense over that 5-year period. So what Dave is saying is that you should go out and you should pay cash for that car to avoid the interest expense. On the surface level, it looks like it makes a lot of sense because you say, wow, if I were to take that interest expense and invest it, and that's the conversation here is like, imagine if you could avoid that interest expense and go out and invest it and compound that for every car that you bought. And like, how great would that be? Okay, well, now I'm going to turn that on him and I'm going to use this against him because here's the deal. We have to think about that access to capital is king and that there's always a cost of money, right? So the cost of money is, and the idea of opportunity cost comes into the cost of money. And the cost of money here is saying, okay, obviously, it's really, really clear if I go finance that vehicle, what is the cost of that money? Well, the cost of that $30,000 is $4,000 in this example, just keeping it really round. If I pay cash for that car, it's not so clear, right? So I think people they don't know what they don't know. So they say, well, if it's not clear and I have the cash and I'm just going to pay it because I know I'm going to avoid this $4,000 expense. But the bottom line is this: I could take that when I hand that money over to the car dealership, to the bank, whoever is, I'm buying that car from. I guess it would be a dealership or a person, not a bank. But when I hand that money over to the dealership, I am now giving up control of that money. I've gotten the car, but think about it. Now what do I have to do? I have to continue saving for my next car because let's face it, it's not going to be my last car. And at the end of 5 or 6 years, if I'm like the average American, I'm going to be wanting to buy a new car. So I have to either save money every single month, right, to get my next car. Otherwise, I'm going to be financing my next car when I put too many miles on the car that I just bought, right? Or when I want a new car just because I want a nicer, newer car, right? Like, so those are things that you have to think about. The opportunity cost here says when I pay that $30,000, I don't just give them the $30,000. I give them everything that $30,000 could have earned for me during that whole time. So we have to look at this, not apples and oranges, like what's the cost over here? I'm going to avoid that cost and just pay cash. I have to look at this from the perspective of saying, okay, I know the $4,000 cost over here. What could I have earned on this, $30,000 had I saved it and let it compound, right? So if the answer is I could earn more than $4,000 on this $30,000 because that's my cost of acquisition over here, right? In this other, in the loan, if I could earn more than that $4,000, then I should always finance it. Now, I'm not saying you shouldn't have money in an account over here where if you needed to pay off the car and cut a check for it, you couldn't do it. Like, you absolutely should implement, rules and systems in place for your personal financial life and your savings in your life, to make sure that you are solid and that you're living with a set of rules that it's going to help you achieve the objectives and financial freedom that you're going for. So I'm not saying that you should go out and finance a car, when you don't have the money for it, because you shouldn't. Like, I mean, that's just, it's pretty simple math. Like, I'll agree with Dave Ramsey on that context, like I said at the very beginning. But the bottom line is, access to capital is king. Paying cash in today's environment, in most environments, quite frankly, is going to cost you more in the long run than actually financing if you handle the cash properly. Because I can show you that at 4%, if I could earn 4% on that money, I'm going to earn more on that 4% than I would actually pay in interest expense at 5%. And why is that? It's because over here, if I'm paying 5% on that loan, I'm paying amortized loans, right? Like, I'm paying a declining amortization on that loan for the car, meaning I'm going to pay a certain amount of interest. 5% is paid every year. Or when you're paying, let me break down amortization. So when you pay on the loan, I start off month one, I owe $30,000. So I'm paying 5% on that $30,000. So a portion goes to interest, a portion goes to the payment of the car, the principal of the car. The next month, I have, like, let's just say $29,600. I'm paying now 5%, broken down, divided by 12 on that $29,600, right? And then the next month I'm paying on less, and I'm paying on less, and I'm paying on less, and I'm paying on less. So your interest expense goes down every month. Now over here, you're earning 4%. And so what happens is you have $30,000, and every month where you're paying less and less interest, even though the interest rate is higher, you're paying less and less and less because the balance is smaller. Over here, you're earning 4%, and the balance keeps getting higher and higher and higher. And even though it's a smaller interest rate, it's compounding because the numbers are bigger. The smaller interest rate is compounding on a bigger number, where the bigger interest rate, you're paying on a lesser number, right? And so that is how opportunity cost works. You have to look at what could you earn on the money. Paying cash isn't necessarily the way to go. You have to really learn how to evaluate the risk reward on this, or the give and take, so to speak, in the sense of what's going to be my cost over here, what could I earn over here on a guaranteed basis, and which one at the end of every period is going to get me where I want to go. And that's how you should be deciding whether you pay cash, whether you finance. And this is why I love infinite banking as a strategy, because this is what allows us to put money into a place where it's going to grow, it's going to get us better guarantees, it's going to get us better rate of returns on our guaranteed, safe, liquid money that we need to operate in our life, for our emergency accounts, for our opportunity accounts, for running major capital purchases like cars through our lives, making sure that we're able to make more educated, more efficient financial decisions. And when you understand this concept of opportunity cost, that is where the pendulum really swings, and people really start to have the light turn on in their mind about what is infinite banking and how can I utilize infinite banking in my life to create wealth. And if you have any questions about this at all, go ahead, look down in the link below. I've got a book you could check out. It's called Cash Flow Hacking. There's going to be a link down below for you to go check that out. You can also just, if you have any questions and you want to have a conversation with one of our endorsed agents, you can go down there, set up a call, have a conversation with somebody, no pressure, but they will be able to break down for you and explain this to you in terms that are relevant to you, right? That are going to be basically putting your personal situation into the equation and figuring out, does this make sense for you? Can you implement this in your life? And it's pretty simple. So if you have any questions at all, reach out, comment in the comment section below. I'll do my best to respond to every single comment I possibly can. If you haven't already, please hit that subscribe button, click the bell. That way you get notified every time I launch a new video. We're just trying to crank out all sorts of, personal financial education videos because, listen, this world is kind of going to hell in a handbasket right now when it comes to the monetary policy, when it comes to the debt, when it comes to where the results are in, the retirement savings, spectrum of this country. It's abysmal. And, I'm really passionate about helping people reach financial freedom as fast as possible. This idea that you have to wait until you're 65 to get there is just ridiculous. So understanding this concept of opportunity cost is one of the first things that you need to understand if you really want to regain control of your financial life. So make sure you subscribe, hit that bell. Until next video, have a blessed, inspirational day, and we'll talk soon. See ya.